Hi, this is Peter with Quantum Edge AI, and we're going to be discussing now the calendar strategy. Now, this is one of my favorite because you can take advantage of three main ideas. One, finite risk. Two, delta. Three, long theta. And your risk is the total debit of that trade. Um, and as long as you don't hold the position to expiration, and you're going to be perfectly fine with this finite risk aspect. Now, you can do two things. You can also take this trade, set a profit target after entry, or you can be legging into this position. You can be long this call, short this call. So you're going to be long the back week, short the front week, and that's what makes a long calendar trade. You can structure this by uh, looking at the distance between these 2 points. For those of you that don't look at the risk profile that often, what this means is we want price to oscillate in this area, or our target is for price to oscillate within this area. What we can do for this specific trade, let's say we're looking at QQQ, and well, let's look at actually a different trade because these expirations are uh, daily. So we can still use it actually, but we can look at the weeklies versus the intra-week. So when you want to look at the weekly, you want to say, okay, well, what's 7 days out? We're going to sell this contract. We're going to sell this contract. We're going to say buy this contract, and that's what the spread is. The short the front week, long the back week. And what we want to do is incorporate quantum edge AI forecasts and analyze the channel and say, okay, well, where is price likely to be? And we can do that by adjusting uh, this strategy to meet the criteria of this forecast. What we want to do is become standardized systematic traders, but we also want to have the ability as individuals to make our own decisions. So it's not purely algorithmic, it's not signal based, it's um, it's portfolio creation. But it's also using our knowledge of options, our knowledge of pairs to make, or spreads in this case, to make consistent trades. So what we want to do here is say, okay, well, what's the differential in the high forecast versus the differential in the low forecast? We're getting to this peaking point in QQQ. The election has just actually happened, and we've had this huge rise up. Um, and it's mainly because of the lack of uncertainty that's happened in the market. Um, the election is now over, and there is a path forward that is known. So what do we expect to happen in this case? I would expect that we would be in this area where price is currently, but we're going to have a little bit of a bias to the downside. The current bias is up, but at some point this this rally is going to fade. So where do we want to place our calendar strategy? We want to place it somewhere in the 510 area. And we can do that by adjusting these points, these strikes, to be um, at the 510, let's say, the closest strike to the close forecast. And what's good about this is we can be in this channel. What we want to do is lock in this location the highest threshold for positive theta. And we want to adjust this to be at the high because we want to make sure that if price does reach this location, we're not going to be, um, you know, negative theta. We want to be able to hold on to this position. So maybe 510 isn't the perfect location to put this. Maybe we want to put it at the 511, let's say. No, maybe the 512. And you can also create a diagonal around this. You can say, okay, well, maybe I want to be a little bit more um, negative in that case, or I want to be a little bit less negative. We can create the diagonal. And what this means is you're going to have a different strike price relative to each duration. So you're going to have a different strike here for the front week, a different strike for the back week. And this is also a recommended strategy where you think this is just going to fade, relaxed, there's not going to be a collapse, but you also want to be delta positive and theta positive. And you also have finite risk on the way down, and you have finite risk if it gaps up and continues. So this is another phenomenal trade. I do love the diagonal structure. But right now we're going to talk about the calendar. What we want is for this to be our target. Where do we believe price is going to settle? Um, and also at the same time be cognizant of where it may be during that time period. So that's why we want to take this trade, and we want to specify in a nice location where price is highly likely to be, but at the same time be cognizant of that risk. And the reason why you want to be adjusting these locations and making sure that this threshold is at a location where you're happy if it is because you don't want to exit this. Like if you're in this position where you're saying, okay, well, if you're wrong, like let's say you're wrong, say you think it's going to be here. Say you're wrong. 508, let's say 508. And it reaches the high forecast. So now you're 518, you're 518.50. And now you've taken a loss on this position and you are now delta negative. Now if you sit in this position, you're going to continuously lose money. That's not the goal of this trade. The goal of this trade is to net this differential in the to net the difference between this contract and this contract, which is roughly only $60. So yeah, you don't want to be here. So if price ends up being here, you're going to inevitably exit the trade, which is, you know, commissions, which is risk for the bid-ask spread, slippage costs. But your potential is you want to scalp something like this out $10, $15 at a time, maybe. But anyway, so you want to be where price is here. This is the golden area where you want price to be. And that is the trade. Um, another another feature of the calendar is the long vega. What this means is that in the event that there's an implied volatility increase, the the spread will actually increase in value also. So if you have this movement where price is currently and it moves down here and it does so in such a way that implied volatility spikes, this value will this spread will increase in value. And we can see that by adjusting the implied volatility by say 10. Let's say we have a 10% increase in implied volatility. Um, This does that. Okay. So 10% increase in volatility, implied volatility, increases the spread, but by roughly, in this case, 40 cents or so. And you have also the opposite of that, which is, say it decreases 10, same thing. But that being said, you still have finite risk in this case, and you cannot lose more than, in this case, $60, $62 plus commission. Okay, thank you. If you have any questions, feel free to DM me or email. Thank you.